The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy Wednesday. You're watching Squawk Box with Carolyn Roth and myself, Steve Sedgwick, and these are your midweek headlines. US equities retreat from historic highs, the Dow dropping for a ninth straight session. This time Nvidia, though, sinking deeper into correction territory. Christmas coming early, well, partially early for the Federal Reserve, set to deliver, we think, don't we, its third straight interest rate cut. That's despite, once again, stronger than expected data. In this case, it was retail sales, whilst calls for future cuts remain mixed.
Japanese exports surge in the month of November, boosted by a weak yen, as the Bank of Japan gathers to make its final policy decision of the year. Nissan and Honda mull a merger as the Japanese automakers grapple with slowing demand and tough competition in the EV space.
A very good morning. How are you?
I'm fantastic. As I told you just before the show, I'm great.
Those are kind of the words you said to me as well. I think there might have been another word in there as well, mildly jaded. No, you're great. Look. We got data on a regular basis which says to me the US economy is in fine fettle. We've got two of the three major US indices which are a decimal away from record highs. With record highs. And yet the headline, the Dow, historic declines, 9 days in a row. I'm getting over it, I've got to be honest. And to accompany that as well, the data is phenomenal compared with the rest of the world. For instance, headline retail sales in the United States, and I made this point about the GDP number for the third quarter, is going to be dominated by a strong consumer. Once again, the retail sales were positive. We'll come to this throughout the show. $724.6 billion was spent versus 718.9 prior as well. Retail sales year on year up 3.8% on the year. The American consumer is employed, is getting more money than they had a year ago and more money than the inflation rate, and is seeing their assets going up with the housing market and the stock market going through the roof as well.
I know where
and
you're
we're
getting
cutting
at.
Rates.
I know where you're getting at, exactly that point. We don't need a rate cut. This is really just because the Fed hasn't been pushing back against the market. It's comfortable with this one. It's probably not comfortable with 5 more rate cuts down the track in 2025. We're getting the dot plot projections today, the SEP, and
is that where the market has its hissy fit, or has the market been suitably soothed already by, let's be honest about it, the vast amount of inane jawboning from a whole host of people who have said exactly the same thing for months? Well, we think we're conquering the battle on inflation, but we also believe that the risks are two-sided. But at the same time, we believe the US economy is in a very strong position as well.
I think weirdly enough, the market is comfortable with being in, knowing the unknown. Is a lot of uncertainties out there when it comes to Trump's policies. We know some of them might be inflationary, some of them might just be a warning to the rest of the world.
No. You're doing something very wrong there.
Why?
You're being pragmatic.
Why?
You're
You're
saying there
markets.
are two-sided risks to the Trump trade. No, you've got to get on board. You've got to get on board your private jet, as I mentioned yesterday, to Mar-a-Lago, park up at West Palm Beach and join the queue.
And donate a couple million.
The queue starts like this. Unfortunately, even though I'm sure you're one of the wealthiest people I know, and I have no idea about your finances, you've got to be a multi-billionaire to start off with, then like I suppose you call them centi-billionaire, then a deca-billionaire, then a billionaire, then a very rich 100 millionaire, whatever, and then eventually gets to the mere mortals, might get to kiss the ring in Mar-a-Lago as well.
Do you mean
because that's how it's working.
SoftBank.
I mean, they're all
100
there.
billion.
They're all there.
They're all there.
All those Democrat voting
Uber.
CEOs from Hollywood, they're all going as well.
Shall we have a look at the U.S. markets?
I think we just gave them a little bit of a tease of what to expect.
So we saw some pre-FOMC jitters. It seems the Dow Jones off by another 0.6%. Steve can talk to you at length about why this is not the best indicator. The S&P 500,
it's a rubbish indicator.
The S&P 500, meantime, which Steve loves, is down by 0.4% in yesterday's trading session.
You don't love the S&P 500.
You don't? Oh, come on.
But
What
I
do
think
you
it's
like?
better than the Dow.
Okay. The Nasdaq also off by 0.3%. We did have a couple of standout performers. Pfizer jumping on its 2025 outlook, up 5%. Tesla at a record high. We talked at length about this yesterday, but there you go. This is, the market taking a step back ahead of the FOMC meeting. And ahead of that, let's take a quick check of treasuries as well. Yields actually trending lower in yesterday's trading session. That was for the first time in about a week or so. The 2-year yield sitting at 4.23%, the 10-year at 4.38%. Let's take a quick check of the dollar. Usually the dollar is king these days, but this morning trending just a touch lower against the euro. The pair sitting at 105.05. Sterling, that was the interesting one yesterday. 127.02 this morning. Obviously, we got the wage data. That was hotter than expected. Today, we're getting the inflation print. We'll see what that does to BOE pricing for the rest or for 2025. Also, want to take you to the Asian markets and see what's happening there. The Nikkei, really interesting this morning, off by 0.3%. But we're going to have to take a look at the automakers, Nissan, Honda, in merger talks. We'll talk about that story later during the show.
We've got Emma Wall waiting. I'll just do a couple of quick reads, but I'll give you a clue. The word is volatility from Emma this morning. The word from Bristol is volatility. So US retail sales rose a greater than expected 0.7% on the month in November, fueled by an acceleration in motor vehicle sales and online purchases. Economists polled by Reuters had expected a monthly rise of 0.5%. The data comes ahead of today's Fed decision, kicking off a key week of central bank action. Bank of America CEO Brian Moynihan told this very channel he's more confident in the strength of the US consumer.
The consumer is more fundamental. It's what's happened is in the middle of summer, I think when we were talking various things, the consumer had slowed down. And I was getting concerned that the Fed was going to get behind a bit on cutting rates. As soon as they said they were cutting rates, you saw consumer enthusiasm pick up a little bit. You saw a little more activity because they realized in the future the rates are coming down. And that started happening, in the September timeframe. And so you started the spending picking back up. And right now, for the 2 weeks around Thanksgiving, it's 5% plus of all kinds of spending over last year. And that's stronger than it would have been last year or the year prior to that.
Well, the former Kansas City Fed President Esther George says she expects today's dot plot projections, here we go again, to show a more gradual pace of rate cuts over the next year.
This is a time to be very cautious as you read the data. The committee, I think, has taken confidence in the fact that inflation has come down significantly. But of course, they're very clear about what their target is. And as we're watching inflation data come in, we're seeing that it's not continuing to decelerate in the same manner that it had earlier.
Today's decision is all but certain to be a rate cut, with markets pricing in a more than 96%. Yes, this is your eye test, all you middle-aged people out there. 96.6%, that says. I'm a bit closer to the screen than you are. Don't cut yourself shaving, whatever you do. 3.4% is the hold. 96% think a move lower. Attention will be on the dot plot, as we mentioned, from policymakers for 2025. Traders are pricing in now 72 basis points of easing between now and the end of next year, with analysts on Wall Street split on the pace of those cuts. Let's get to Bristol. Emma Wall is head of platform investments at Hargreaves Lansdown. Emma, lovely to see you. I hear what you're saying about volatility, and we're seeing a hint of that being spiced into these markets at the moment as well. But by and large, the trajectory has been northerly. Do you still think markets are going up in 2025?
Yes, we do. Although, as we say, volatility is the key word. We think bond markets, we're bullish on bonds. I have to say, I'm not going to be contrarian here. I share the consensus view that the Fed cuts today and also potentially twice more in 2025. But ultimately, volatility creates investment opportunities. So we're bullish on bonds if you take an active stance to play that volatility. And we're broadly bullish on global stock markets. But we do think, with the new geopolitical risks, the White House, and the macroeconomic data that's going to be coming through, we do think it's going to be a bumpy ride for 2025. But bumpy rides create opportunities.
Do they at a bottom-up level, Emma? Because this is where I'm very interested. Some of the cheapest stocks I've ever seen in Europe are in existence across various sectors. I can find them in retail, I can find them in telecoms, I can find them in autos. and yet they keep going down. I've spoken to so many professionals and private punters as well, who quite frankly own stuff that keeps going down regardless of the valuation. Are these great opportunities, or actually do we just need to get on with the momentum trade, buy the growth stuff and sell the rest?
Yeah, I think it's 6 of one and half dozen of the other, by which I mean we think the greatest opportunities for 2025 are in fixed income. You get rewarded with income for now, and although it's going to be slower to cut, the long-term trajectory is yields will come down, so you get that total return. We also like US smaller companies, so I'm not sitting here and say, buy the troughs of Europe. We think that remains incredibly challenged, particularly from an economic point of view. France, Germany, definitely not out of the woods there. But things like US smaller companies, we do think, although they're not on the lowest valuations ever, you still actually can pick up some great opportunities there. And the macroeconomic view is supportive. If these 20% tariffs come in, the stocks they're going to penalised the most in terms from a US point of view are going to be those larger opportunities. And also we think the US smallers are still reasonably under-owned. Talking specifically to our client base, what have they been buying steadfastly over the last 2 years? Well, it's been those large US names. So we do think with lower corporation tax, lower personal tax, Trump is likely to be supportive of US smaller companies. So it's buy the volatility, but buy the volatility in areas where we think there's headwinds, both from a kind of bottom-up point of view, but also from a macroeconomic point of view. Politics is going to matter in 2025.
Emma, this is Carolyn. You make a great point about the small stocks in the U.S. still being under-owned. Obviously, we saw that big rotation into small caps since the summer of this year on expectations that they would benefit from FOMC cuts. Now, this year, small caps so far up 17%. Not bad, but not as great as some of the large caps. And small caps have underperformed big caps for the last 7 or 8 years. Why would 2025 be the year when they actually outperform?
I think a couple of things. I think interest rate stability. So, I'm not saying that interest rates are going to come down significantly and so the cost of borrowing is suddenly going to be zero again. But we have had a lot of uncertainty this year in terms of, you remember, November 2023, we were expecting to have had, 7 rate cuts by now from the Fed, and we've not had that. And we do think actually with the data coming through being more consistent, actually the rate environment is more predictable. So that helps smaller companies. That helps any company really, because you can begin to sort of plan your cash flow, plan any debt that you acquire. We also think that the specific political stance from Donald Trump in terms of lower corporation tax and lower personal tax will be supportive of US smaller companies, and they're less likely, because on the whole they tend to be more domestically focused, or not every single one, they're less likely to be penalised by any trade tariffs because they're less likely to be doing business globally like those larger companies. So do think it's a bit of continuation of a similar theme with some macroeconomic and political tailwinds for that sector.
Emma, I do wonder to what extent tariffs will only be a bargaining chip for Donald Trump and not necessarily be put in action, but it remains to be seen. You also like gold, but you're not super bullish on gold. You just think it will keep its value. It's had a fantastic run this year. It's been on a tear, up 29%. But you argue investors should simply hold on to it?
The thing with gold is we're saying we don't think this is going to be another 30%. As you say, it's been an incredible year for a variety of reasons. But what we do think is it is an asset class that does offer real diversification, particularly if we see some concerns in terms of, the picture in the Middle East, the concerns about what happens with the war in Ukraine. So it is one of those asset classes where we think it has potential to retain its value. So if it's used tactically in a portfolio to add ballast and add diversification, and particularly for those investors who are looking for a total return strategy, looking for a capital preservation strategy, perhaps they're older, perhaps they're in retirement, and they need something, a cash-like instrument that's going to provide that safe haven. That's the role we think that gold plays in a portfolio over the coming 12 months. We don't think it's going to be another 30% return like it has been year to date.
But a very interesting story, which you would have read as well, Emma. I'll paraphrase from Fortune. UK billionaires investment fund is aggressively selling Magnificent Seven stocks amid growing fears of AI backlash. The man in question is Peter Hargreaves as well. Just wondered what you thought as well of the eponymous Hargreaves Lansdowne founder.
So he's no longer involved in the company, so I can't possibly comment about his personal trading. But in terms of what the trends that we're seeing for our client base, the Mag 7 are still incredibly popular. And actually, our equity analysts have done their picks, 5 stocks for 2025, and they've put Nvidia in there. So we are being selective in terms of where we think there's continued growth in there. But Nvidia, I'd have to say, our equity analysts, we've challenged them a lot, but they are very bullish on the stock for 2025. They just think that the fundamentals, are there for that company, and you're seeing good data coming through. I think you have to be a bit more selective about the Mag 7 as a whole and take this opportunity to take some gains. I mean, at the end of the year, as well as unwrapping presents, it's always quite a good time when you go into January to think about how's my portfolio weighted? Actually, how have the rally of the last 12 months, or indeed the underperformance of the last 12 months, affected my asset allocation? So we're saying take stock, take some gains off the table, but our equity analysts are bullish on Nvidia for 2025.
Glad you mentioned unwrapping presents. What are you expecting? Something lovely from New Bond Street, maybe?
Fingers crossed. I think the older you get, the more you like presents that come in smaller packages.
A little red one or a little powder blue kind of one, maybe, or something. Lovely. I did go on the latter site, actually. Yes, my eyes were watering at the expenses now. There's nothing cheap from either of those shops anymore. Emma, lovely. And what time do you open your presents? Are you like a 5 a.m. with the kind of person, or do you wait till after supper?
Stockings early, but to open your big presents, you have to wait until the king has spoken. We're very British over here.
Oh, 3 p.m. and a bit of change. Yeah, although I'm in a lot of trouble because we were so late getting down to lunch. We had to watch the king on catch-up this year. Last year, I beg your pardon. Terrible. Anyway, lovely. Thank you very much indeed, Emma. I hope you get everything you want in a very small box from New Bond Street. Emma Wall, head of platform investments at Hargreaves Lansdowne. Other streets in London are available. In my case, more Tottenham Court Road than New Bond Street. What about you, Carolyn?
I've got everything I need in life.
You've got everything you need?
Everything I need in life. I don't need any presents. I just want time with my family.
Oh.
I know, it's so cheesy, right? But it's true.
No, it's quite emotional.
If you want to get me something, feel free. Anytime, anything from New Bond Street, I'll take it.
Not only have I been ahead of the curve this year on presents, I have wrapped up probably about 30 presents already. For more on what to look out for ahead of today's Fed decision, check out CNBC.com. Also, the Fed is just at the start of the central bank action we're looking forward to this week. Tomorrow, we're going to hear from the Bank of Japan, Bank of England, the Riksbank and Norges Bank. Carolyn, what's the details?
Yeah, still coming up on the show. Nissan shares accelerate after it confirms talks with Honda over a potential merger. We'll bring you all the details next. Plus, we'll look at what 2025 may have in store for Bitcoin as the cryptocurrency continues its post-election rally, and we'll take a deep dive into AI infrastructure and the broader UK economy with the former CEO of ARM and Rolls-Royce, IET President Warren East. That conversation is coming up at 7:30.
Japanese exports rose in November amid a weak yen, up 3.8% on the year. That was better than expected and came as chip-making equipment and non-ferrous metals outperformed, whilst cars were a drag. Talking of cars,
big story out of Japan. Nissan shares accelerated as the Japanese automaker confirmed a media report that it is considering a merger with Honda, forming a bigger entity that can compete with larger rivals and invest more in the growing EV market. The Nikkei newspaper first reported the possibility, which could see Mitsubishi being brought into the fold as well. Lin joins us with all the details. And Lin, there's so many angles to the story, one, of course, being potential political opposition to this.
Hey, Carolyn. Well, that is certainly an angle there, because we know that if there is some sort of a major merger, it could mean job losses. So putting that out there as well as a key risk. But in terms of the deepening of ties here, there's still a lot of questions unknown. What we do know is that they are looking at ways of collaborating further. Back in August, they announced a strategic partnership in terms of EV software. So So, we've got media reports saying it could come in the form of some sort of a holding company structure where these two entities would sit underneath, or it could be kind of like a capital tie-up a la Renault Nissan from a few decades ago as well. Certainly what this does underscore, of course, is just how much the auto sector around the world, particularly also in your neck of the woods, has really, really changed. And it's really underscoring, of course, the challenges and how it's been reshaped by the EV makers, particularly in China, BYD, amongst a whole host of other EV companies and Tesla. And I guess in terms of what is at stake here for Japanese automakers, generally speaking, they are losing a lot of market share, particularly in the largest market in the world, which is China. Generally speaking, Japanese automakers have been slow in terms of adopting EV technology. Sure, if you remember, Nissan did bring out the Leaf under Carlos Ghosn, the first mass market all-electric car. However, they have really fallen behind. They weren't able to gain that first mover advantage for a variety of reasons. And as analysts are telling us, this tie-up is about saving costs. It's about increasing scale and capacity. And we see this in Nissan's share price reaction as well for that company. It really is about survival. So its share price was before today down about 40%, of course, rising about 24 today on this news. But, we know that it's been really struggling. It's not only losing market share in China, but also in the United States. Analysts have told us that, it doesn't have, a very attractive sort of model or range. It doesn't have an attractive hybrid range. That's why it hasn't been very competitive in the US as well. So a whole host of challenges for this company, but certainly good news perhaps in terms of survival for Nissan, guys.
But Nissan has one thing going for it, and that is the manufacturing capabilities when it comes to the U.S. And let me bring geopolitics into the mix here, because that's increasingly important given the incoming tariffs under Donald Trump. So is its primary advantage to any potential buyer out there, not just its low valuation, but the fact that it's got the footprint in the U.S., and that way one can avoid those U.S. tariffs?
Yeah, I guess that is a point there. But the other concern is with the US tariffs, that could potentially impact, basically all automakers outside of the US. And we know in terms of Nissan's manufacturing capacities, production capacities, it does actually have a big footprint in Mexico as well that imports into the US. And of course, we know that Mexico could be a potential target in terms of those 25% tariffs. But, certainly when it comes to the US market, so crucial for Japanese automakers because they are all losing market share, including the big one there, Toyota, if you look at the monthly numbers as it relates to China. So that is going to be the focus. And, what analysts are saying is that it does have a footprint in the US, but it doesn't have an attractive hybrid range. And that's something that Honda can bring to the table as well.
Thank you very much indeed for that. There's many problems. 1, the cost base. 2, the wrong cars. 3, the cheap competition. 4, the lack of policy support globally. They were told that they would get policy support. They were told they would get the fast chargers on every service station, on every street as well. And governments from Germany to the UK have been incredibly slow in delivering. There are some countries that have knocked the ball out of the park. I think some of the Scandinavians, for instance, as well.
Norway.
Exactly, they are Scandinavian. The point also is they are a nightmare in terms of value for money buying these cars. The fact of the matter is, you buy a new car, you buy it on a PCP plan because most people do buy them on a PCP, or you buy it outright as well. The value of those vehicles is diminishing aggressively in the first 18 months to 2 years, more than I've seen on any car depreciation in the history. I've been looking at cars, and I've been looking at cars since I was 17 and bought my first one as well. Plus the fact there is a mis-selling scandal from a lot of UK financial providers at the moment as well about mis-selling car loans as well, and that's going to cost the industry a lot of money as well. And that's one of the few areas, financing, where a lot of these companies have made a lot of money. OEMs, they make very poor amount of money in terms of margin from actually selling the car. But now, actually, it looks like the one area where they do make a lot of money, which is on financing, actually there might be a lot of problems there.
All very valid points. I'll add one more to the mix, and that is the fact that why haven't they gone heavier into hybrids? Because
they are now. They are.
Well, but that's too late. Toyota is doing a stellar job on that, and we know that as demand drops for EVs and the traditional cars, the combustion engine cars.
But that's a failure, isn't it?
Why is the hybrid a failure? Take a look at some of the selling numbers when it comes to Europe. This is one of the fastest
because it's a failure to sell
cars.
the technology. That's the point I'm making. People are going back on hybrids because, I only do the short hop, I only do the short hop. But actually, if you look at what hybrids promise in terms of range and actually what hybrids deliver in terms of range, it's pathetic.
Would you have range anxiety when you're sitting in a hybrid?
Of course not. But I don't have range anxiety when I sit in my ICE car, any of my ICE cars. And the fact of the matter is, I would be very, very glad to buy an electric vehicle at the right price. If there's facilities available on a regular basis for me to have to charge and not being ripped off for the charge as well, because that's another thing. A lot of the costs from some of the energy providers for providing the roadside charging have gone through the roof as well. I can see why so many people are turning their back on EV because it's been a task. And going to hybrid, I'm sorry, most of the time people who are doing distance journeys are using the ICE engine. The hybrids just kind of like make them feel better, perhaps from the guilt point of view.
True.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.